This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Patrick, I want to get to the big question from the market wrap. Is the market bottom in down at 4,200 or whatever it was on the S&P? Looking at about 4312 on S&P futures as we're speaking on Thursday afternoon. What's the answer? Is the bottom in?
Well, let's look at page 2. What is interesting is just using the moving averages of the 50 and the 200-day just as kind of an idea of where the prevailing uptrend kind of key levels are. We're trading now for the first time since June of 2020 below both moving averages. So it just shows the magnitude of the selling and just how oversold we are on the short term. We haven't had a proper 10+% market correction in a very long time. And that's exactly it, a correction. And the question in the bigger context is a 10% correction sufficient, or do we need a larger or deeper variety one to really kind of finish washing everything out? Now, what is interesting is that so far, every rally that the market has put together this week has, after just 100 quick S&P points to the upside, immediately is met with selling and distribution. So we have not seen some sort of a buy cycle come off yet. So the market remains quite vulnerable at this stage, trading down along those lows. Now, what the bulls do have going for them is on page 3 when we look at the Volatility Index, which is that one of the things we highlighted last week was that we didn't see that spike in volatility yet, which made the market still vulnerable, that there wasn't yet that kind of capitulation selling, that fear built up in the market that would typically be associated with some sort of a tradable low. Well, this week we got it. I mean, we printed almost as high as 40 on the VIX. That kind of scare drop did happen. And this is where we're going to get some incredibly valuable information. Typically, once volatility spikes this high, on balance of probabilities, more often than not, the reversion of the volatility back down to the low 20s has a tailwind to the equity markets, which slingshots them higher, and a bottom usually is established. And what will be really interesting to see is what happens here at this moment. Because in the past, when we had the really ugly events, such as, let's say, March 2020, volatility just would not go back down, and it would just keep slingshotting higher. The bottom line is that we're at a really important, critical moment. If we see that the bulls can dig in and hold the FOMC lows, like the lows that came in from that selling, and we turn things back up, a rally back to 4,600 would be very natural. But if every rally is failing and we continue to see intraday selling just keep hammering the market, once we're down at 4,300 or below 4,300, the vulnerability is that we are going to still have one more quick drop on the downside. The analog I like to think of in the back of my mind is what happened during the 2018 Christmas massacre. While the whole market correction played out over multiple months, there were two very violent rallies in between that were 300 plus S&P points to the upside. And I think the key thought that I have there is that even if we did have a very fast and rapid snap in the market to the upside, can we trust it? And it's a great time to just be watching these markets on an intraday basis and reading the tea leaves, because there's so much opportunity out there, and just trying to figure out where the selling has finally subsided is going to be critical.
Moving on to page 4, we've got the Euro-US dollar cross. Boy, there's a big nosedive there after the Fed meeting. What's going on with this chart?
Right. And I mean, we always look at the dollar index, but the big traded weighted currency in there is that euro. And the euro had a couple weeks ago a quick pop up towards 115 on the upside. And we were just at that time trying to determine whether that was actually a meaningful breakout or was it a fake out. And it stopped right in the Fibonacci retracement zones and has now decisively turned. But with the fact that we have now broken those November, December consolidation lows, there is the vulnerability of the euro to trade back down to 2020 lows is on the table. And I mean, at this stage, with this breakdown, we could see 110, even 108 on the downside during one of these sell sequences. At some point, the dollar will likely peak out. But the question in my mind is it one of those things that's going to be more timed around the March rate hike? Maybe what it is that we'll spend much of February with dollar strength and euro weakness as the dominant trends, and it will take something like that first rate hike in March to potentially put in a short-term dollar top. And that's it's going to be really interesting to see how this continues to trade out. With that said, Eric, let's move on to page 5. And I wanted to just touch on the crude oil, but also the time spread chart that you wanted to talk about. So right now, you can clearly see on the continuous contract, oil did break to that higher high. I mean, after even a little 3-4 day pullback with the break the way it's doing, it seems like $90 is just in reach, and that we realistically can see it here. What's your take on this chart, and how should we look at those term chart futures spreads?
Well, Patrick, first of all, I do think that we've got further to go to the upside. I am still bullish on crude oil here, but I'm going to throw in the caveat that the easy work is done. You know, it's $62. It was very easy to say this is an Omicron panic that is misplaced, and we're about to see a reversal. We did say that here on MacroVoices. What happened next is we saw the very predictable, not just 100% reversal, but more than 100% retracement of that Omicron panic move down. Okay, well, now we're back up to cycle highs. We're, above $85 here. We're at the point where crude oil really becomes a serious political issue, and there are significant political headwinds to higher prices. And of course, the Biden administration wants you to think that they've been working all along on keeping gas prices down. Well, now it's at the point where shit gets real. We're not just talking about people are a little bit annoyed with the gasoline prices. They're really getting pissed off. And the thing is, it doesn't matter how pissed off they get. I don't think anything is going to stop all of the fundamental factors that are pushing crude oil prices higher. But I do want to emphasize that I think right now, when you see these really elevated prices in the high 80s and you think, oh, okay, maybe that just means that there's really a long-term expected increase in demand. Actually, that's not what the market's telling us. And let's move on to page 6, where we look at the time spreads, which is the measure of the difference in price from one contract to the next. So you see the yellow line there that's labeled H2-J2. That says the price of the March futures contract, the one for delivery in March of 22, is priced $1.35 higher than the April of 22 contract. That's J2. And then the next one, April to May, is the next one down. The purple one at $1.19. May to June is $1.11. June to July is $1.03, and so forth. Well, it's unusual for these spreads to be bigger than about 50 cents of backwardation on a one-month basis. What's going on? The reason for that big premium on the earlier delivery contract is there's a growing fear of a shortage of physical oil to settle the WTI futures contract. And it used to be that we went really by the physical inventory that was in Cushing, Oklahoma. These days, a lot of these contracts get settled through exchange for physical settlement mechanisms where the oil could be someplace else, but it still has to be deliverable against that WTI contract. So one way or another, the physical oil market is getting really tight, and you're seeing that with the blow up of time spreads. And this is a repeat of something that happened in October and November when there were really significant fears of Cushing, Oklahoma getting down to its minimum operating limits. So that situation continues to develop. Of course, you never know when it's going to reverse, but I think that's driving a lot of the upside pressure on the flat price of oil. Let's move on to gold futures on page 7. You see those two really, really big down candles at the very right-hand side of the chart. But, just visually looking at it, it really doesn't take us that far out of an established uptrend. In fact, it looks in many ways visually like this is your buy-the-dip moment if you don't think this thing's going to break down. So what should we think?
You know what? It comes back down to even the way that we approached the euro and the dollar kind of outlook. What is clear is that maybe gold bulls are just looking for the move a little too premature in this cycle. While I'm not bearish gold, it is increasingly likely that we're going to go back into the purgatory trade range for a little bit of a short period of time until a lot of these intermarkets finish these cycle moves. I mean, we've seen in the past as well that during periods where the stock market is risk off, that doesn't tend to have gold rallying until after the selling cycle has finished. So right now with this reversal, this does take the wind out of the sails of the gold bulls, and it does likely increase the probability that this thing is going to be far more range bound in these. And I think that it's going to take maybe a good chunk of the first quarter to really establish that base that will kind of drive gold higher the way Ronnie kind of describes some of the catalysts behind it. So right now, one of the things I'm just going to be watching is whether or not the bottom end of these trade ranges now hold, which is like the 1775 areas where a lot of the consolidations lows have happened in the past. But what I wanted to do, Eric, is move on here to page 8, where we look at the 10-year Treasury note futures. Rather than normally we look at rates, but I wanted to look at the actual bonds themselves, which move inversely. And really what I thought was just worthy, because Ronnie talked about it as well in that interview with you, is just that many people in the traditional 60-40 portfolio or the risk parity funds have always anchored off of the 10-year notes as the kind of anti-risk off asset that will basically do well when other things are doing poorly and reduce the overall volatility of portfolios. And it's actually amazing to me how the markets have really started to wobble and turn, and that defensiveness that the 10-year note has shown in the past just has not emerged at all. And that certainly is heightening portfolio volatility overall. And I wonder whether or not this is actually going to contribute to even more volatility moving forward in portfolios.
Patrick, the next 4 charts, starting on page 9, we're looking at the global equity indices, stock markets from Japan, China, Australia, and South Korea. Why these particular charts, and what are they telling us?
I cherry-picked just some of many of the global markets out there, but I think that the one thing I really wanted to capture to wrap up the chart deck was we keep looking at this as the Fed and the U.S. equity markets. But what is important to just stop and reflect upon is that there is the rest of the global marketplace, which in general, central banks are tightening. They're in line with what the Fed is doing. And a lot of global stock markets are demonstrating similar style weakness. And so this is not just about the FANG stocks driving the selling in the U.S. equity markets, but we are seeing substantial price deterioration in many global indices. As developed markets, I maybe should have included the Euro stock weakness in this chart mix as well, but like the Nikkei is breaking below a 1-year trade range on the downside, very similar to what we saw in the Russell 2000. China continues to be trading at the bottom end of 1-year ranges, well off of its major highs. Again, Australia was in a substantial sideways trade range for 6-7 months and broken that to the downside. And then a lot of these kind of Asian markets like the South Korean index are in outright sell mode. And in fact, the selling is almost accelerating in those markets to the downside. And I think that it's very important to when kind of sizing up what's happening in the U.S. equity markets, recognizing that the global equity complex is very weak. And there seems to be a lot of bear market style price action happening everywhere in the world. And I wonder whether or not it's really as simple as analyzing the Fed and the U.S. markets when the entire system is under so much pressure.
Listeners, Patrick emphasized earlier the importance in this environment of keeping an eye on these markets on an intraday basis. Well, if you want to get Patrick's chart decks and webinars not only once a week, but every single day of the week, be sure to check out page 13 where you can get information about a free trial of Big Picture Trading, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the Internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.